In 2025, making money online has never been easier. As long as you have access to electricity, you stand a chance at making hundreds of thousands, if not millions of dollars online, thanks to the level playing field of the internet. Whether for good or for bad, all you need to make money in this day and age is this right here. In this video, I'm going to show you one of the many ways to make money online through crypto trading. With over 12 years of experience trading, seeing my fair share of up and downs, I can almost guarantee you that I am able to explain trading in a way that is so clear to understand that by the end of this video, you will have enough information and knowledge to go and start making profits today. In fact, somewhere in this video, I'm going to give you not one, but two free strategies that I have personally tested so that you can start today with everything you need. So with that being said, let's get started. Now, before we dive into the more complicated stuff like the charts and the brokers and the software that you're going to need, and don't worry, it's all very simple when you understand. First, we have to define what trading even is, and it's very simple. Trading is just the act of giving one thing in exchange for the other in hopes that what you paid for will increase in value so that you can then go and sell that for a profit. At its very core, that's what trading is. So obviously, that's a pretty broad definition. But when it comes to trading online, there are a few different things that you can trade. The most common that most people are familiar are going to be things like stocks, right? You're paying a dollar, trading a dollar or dollars for a small piece of a company. That is trading stocks. And you do this in hopes that the company will appreciate, therefore the price of the stock will appreciate, so that when you sell that stock, you get back $2. But there are other things you can trade. For example, instead of stocks, you can trade currencies. This is what's called Forex. You may have heard of it. Essentially, this is trading one currency for another in hopes that that other currency will increase in value, or in some cases decrease in value, so that when you trade them back, you can make a profit. Trading cryptocurrency is pretty similar in the sense that you are trading some sort of currency. It's just now a digital currency. You are exchanging US dollars or USDT or whatever currency that you personally are using for a cryptocurrency like Bitcoin, Ethereum, Solana, in hopes that that asset or crypto will increase in price relative to the dollar or whatever currency you use to pay for it. Now, there are two core components that you will need in order to trade. Back in the 1900s, if you wanted to go buy a stock, for example, you would need to physically walk over to what was called a broker. The broker would be the person that would exchange you a slip of paper representing the piece of that company in order to exchange it for your currency, or in that case in America, US dollars. That was called a broker, the middleman between the actual valuable asset and the buyer or seller. You need a broker in order to trade cryptocurrency as well. This is where you are going to actually buy and sell the cryptocurrencies. Don't worry, we are going to cover a broker and how to use them in this video. So that's one component. The next component is going to be a charting software. This is a software or website that you use to actually look at the price charts, because in this video, we are going to specifically cover technical analysis, which is the speculating on an asset based off of the charts and the price action in those charts. To put it in simple terms, we are going to try to use the historical price of the cryptocurrency to try to predict what may happen with the future price of that cryptocurrency. So those are the two main components that you need to start trading: a broker and a charting software. Some brokers may offer a charting software within them, but most of the times they're not as good as the software that I'm going to show you. So let's dive into it. So what you're looking at here is a website called TradingView. This is the golden standard as far as charting platforms are concerned. Almost everyone that trades in this industry is pretty much using this in one variation or the other. So I recommend you use this charting platform. It is the best by far. I'll put a link in the description for it down below. So this may look pretty overwhelming, especially if you're a complete beginner, but I promise it is very intuitive and very easy to use, and I'm going to break it down for you step by step. So on the left side, this is going to be your toolkit. This is where you can have things like, for example, a marker to draw on the chart to help you kind of visualize what you're looking at. And if you don't even know how to read this chart yet, don't worry, we're going to go over that as well. So your toolkit is separated into a few different sections. Now, I don't recommend going in here and continuously looking for the same tool over and over again. And most people don't. That's why they have the star feature here, or the favorite feature. If you click on this little star right here on whatever tool you're using, and we'll break down some tools here, if you favorite a tool, it will appear up here in your favorite toolbar or your hotbar. This lets you make sure that you have all the tools that you commonly use ready to go at a moment's notice, so that you don't have to keep going over here into the left and opening these drop-down menus. Now, I'm not going to go in depth on how to use every single tool because that would be over an hour of video content, but I will give you my personal favorites and what they do. So the first tool that you're probably going to want to get accustomed to is the trend line tool, or put simply, the line tool. This allows you to draw lines on the charts, or if you just want to kind of mark up the chart in straight lines, then this is going to be that tool. Great tool, very versatile, and very simple. It's just a straight line tool. Now, the next tool that's a little bit better for drawing out specific price points, if you really want to hone in and make sure you have a nice straight line, is going to be the horizontal ray tool. And you can find this in the same section as the trend line tool or the line tool. The horizontal ray, if you just put it anywhere on the chart, it is going to draw a horizontal ray that ends where your cursor was placed, and if you want, you can drag it back and forth like this. Now, you may notice that when I am selecting a tool, my cursor kind of hovers over and sticks like a magnet to these different areas of the chart. And again, if you can't read a chart, we're going to go over it, don't worry about it. But you'll see that my cursor is sticking to the chart. This is what's called the magnet feature over here, and you can enable it or disable it like so. And when this is disabled, you won't see that sort of stickiness, right? So if we disable it and I go close to the chart here, you can see it's not really latching on to anything, and it just goes wherever I put it. But if we turn that back on, you'll see that it'll start automatically placing itself at different price points. Now, one thing that's really annoying is that if you want to disable it, you have to keep going right back over here, clicking that, blah, blah, blah. No, you actually don't need to do that. If you have magnet mode enabled, to disable it, just hold Control, or on a Mac, probably Command, and it'll automatically disable it so that you can place your tool anywhere you want without getting disrupted. Now, probably one of my favorite tools to use is going to be the brush tool over here. And the brush tool is very self-explanatory. It is a brush that allows you to draw on the chart, but this makes it so easy to, for example, if you're recording a video or trying to show something, right, you can just draw it out on the chart, circling different areas, drawing lines, doing whatever you have to do. Very useful for visualizing different things on the chart. Next, we have the text feature, which just lets you mark things up on a chart. So that is pretty self-explanatory as well. You can type anything you want on the charts. Now, TradingView is very customizable. So for example, if you want to edit anything that you have on a chart, for example, a line or a text, you just have to hover over it and double click, and that will bring up the settings for that drawing or that indicator, whatever you have. So you can see you can actually change the visibility of something so that it can show up on different time frames. Some other tools that are a little more advanced that I like to use are going to be the Fib retracement tool, or the Fibonacci retracement tool, the trend-based Fibonacci extension tool, and the Fib time zone I don't really use as much. As a matter of fact, let me get rid of that. Okay, now I'm going to cover these later in the video because they're going to be involved in our strategies, but just so you know, and you can start getting them ready right now. Now, another really important tool is going to be this tool right over here, or should I say two tools, the long position and the short position. Basically, these tools let you visualize your risk and your reward in any given trade. So for example, a long position, which is the same as a buy position, you're buying, you can put this at a level that you may want to buy at. You can see the price over here on the right side. Let's say we want to buy at $100,000. So when Bitcoin reaches $100,000, we want to buy. So if we want to visualize what this might look like, we're going to click around that $100,000. And if we want to get out for a specific loss, if price continues to move lower, let's say we want to cut our losses if Bitcoin goes below 95,000. So that's to say that I bought Bitcoin at 100,000. If it goes below 95,000, I want to sell and cut my loss. Well, now we have that visualized where we actually are going to cut that loss as relative to the chart. And same thing with the reward. Let's say we want to take our profits at $110,000. So we want to buy at $100,000. If it drops below $95,000, we will sell for a loss. But if we get to $110,000, we will sell for a profit. Now we can actually visualize this with a risk to reward ratio. So this means that for every dollar we risk, how much are we going to make back? Our risk to reward ratio here is 1.8. Another way of thinking of this is if we just use a box, for example, a box tool, and we just copy and paste that over here, you can see that it's roughly about 2 boxes. That is because our risk to reward is 1.8, which means we are going to make $1.8 back for every dollar we risk. Now, if this were to go to 2, now the risk to reward ratio is 2. Well, if we do that paste trick again, we will see that 2 of these boxes, which represents our risk, now lines up perfectly with that risk to reward. So it is a visual way to see how much you stand to gain and how much you're risking in order to gain that amount. So that is the risk to reward tool. And we also have the risk to reward tool for a short position. Now, if you're a total beginner, you probably don't know what a short position even is. But basically, to keep it very simple, it is the opposite of a long position or a buy position. It just means that you are betting that the crypto will actually fall and you will make money if it does fall. So for example, if we want to short at current price at $106,000, let's say if it gets to $110,000, we will cut our loss. So yes, if the price increases, we will actually lose money because this is what's called a short position. But if price does end up falling, let's say to $100,000 a coin, then we will make a profit. And this is the visual of our risk to reward. So the risk to reward ratio is 1.6. So that means that we stand to gain $1.6 for every $1 we risk. Now visually, it just is flipped on its head. That's really all this is. The difference between the two tools is that one is the upside down version of the other. Now I don't want to spend too much time on just the tools alone. So feel free to play around with them as you choose, and I will be explaining more of them later in this video when it becomes relevant to the strategy. But for now, we've covered the basics on how to use those tools. Now, lastly, if we have, for example, a bunch of drawings on a chart and it's getting really overwhelming and we just want a clean chart again, but we don't want to have to delete all of these, which we could if we hold Control and drag. We could select all of this and hit delete. But an easier way to do that, if we don't want to delete them, is to go over here and hit the hide button, which will just hide the drawings temporarily. And if we want to see the drawings again, we just click that same button. So as you may have seen earlier in the video, if you want to change time frames, that is going to be at the top left over here. Next to that, you'll see we can actually see the symbol or what we're actually looking at. So this is a Bitcoin chart because BTC USDT represents Bitcoin and the USDT cryptocurrency, which is just the US dollar in a digital form basically. And so if we want to change the time frames, we would do so right here. For example, if we want to see a weekly chart, each one of these red and green candlesticks now represent 1 week's worth of time. And you can see that by looking at the date down here. You can see as we go back, we're going back 1 week at a time. Monday, December 2nd, November 25th, November 18th. Okay, now if we go to the daily time frame, well, now each one is going to represent a day. So again, look at the dates down below. We got the 17th, the 16th, the 15th, the 14th, and if we want to say let's go down to a 1 hour time frame, well, you get the point. Now each one represents 1 hour worth of time. We'll see how time frames come into play later in the video, so just make sure to keep watching and it'll all make sense. Now, if you are a beginner and you don't want to deal with these candlesticks here, which you should, it is very important to understand, but if you theoretically don't, you can change the style of the charts right over here. So if you just click this drop down menu, we have a bunch of different charts. I'm not going to go over all of them, but for the sake of this video, let's say you don't like candles and you want a line chart. You're going to click this, and now it's probably looks a little more easy and familiar for you to understand. Obviously, this is a chart that is going up, but personally, the candlesticks are much more valuable to me, and you'll see why later on. In trading, there are overlays that you can put onto your charts that will use the price or the chart to give you an indication of where price may go next. These are what are called indicators, and you can see them up here on this segment here. So if you click indicators, you will be able to search different types of indicators. There are literally thousands, if not tens of thousands of indicators out there. For this video, we will be covering the RSI indicator, which I already have on my chart, but you can see it's right there. Once we click that button, we are going to see that indicator down here. And now, obviously, if you're completely new, you won't know what this means at all. This indicator is an example of what's called an oscillator. So it oscillates back and forth between two extreme levels. When the level is above a certain point, it means that price is a little overextended and may start to come back down. When the level is below a certain point, it means price is a little overextended to the downside and may start to come back up. So it's oscillating between two different extremes on the chart. There are also indicators that go directly onto the chart, whereas oscillators usually are below the chart. There are some indicators that go directly onto the chart. For example, we have moving averages, which are basically just the average price for an X amount of time. So the red is the 10-day moving average in this case. So that means it is the average price for the last 10 days of Bitcoin. The blue is the 20-day moving average, so the average price for the last 20 days, and the yellow is the average price for the last 50 days. Now these help us usually visualize whether price is moving up or down, and they also act as areas where price may continue to move in that direction. So for example, when all three of these are moving upwards, we can pretty confidently say that price is trending higher, and we can even say that if price comes back to these yellow, blue, and red lines, that they may even be a good place to buy because they're following that trend. More on this later. So those are different types of indicators. Now let's talk about the watch list. The watch list will be on the right hand side of your TradingView chart, and this is where you can check out different prices of different cryptocurrencies that you add to the watch list. It is the list of cryptocurrencies that you're watching. So to add cryptos to your watch list, you have to click on the plus icon right up here on the top right. We click that, and now we can start searching for different types of cryptocurrencies. So for example, if we wanted to add Bitcoin, we could look up Bitcoin, and we will see a bunch of different types of Bitcoin. Now, there's not really a difference between these other than the fact that they are from different data sources. On the right side, you can see these are different brokers or data providers. For the sake of simplicity, you usually want to add the chart that is coming from Binance, because Binance has some of the world's top liquidity and the best data for cryptocurrency. So that just means that the charts are going to be as accurate as possible to the real-time price that is actually being recorded. So what you can do is go to sources right over there and just add a filter where you only want to see Binance, and now all of what you search up will be coming from Binance. So this just makes it way more simple so that when you search up something like Bitcoin, you don't have as many search results. By the way, not sponsored by Binance at all. So now let's search up Bitcoin again, and we are going to see that we have Bitcoin / US dollar. What does this mean? This means that we are buying Bitcoin with US dollars. Now you also have BTC / Tetherus. USDT is Tetherus. Same thing. Tetherus is a cryptocurrency that is worth $1 and it never changes. This is what's called a stable coin. So let's do the same thing with Ethereum. We can do the same thing, Ethereum versus the US dollar. For example, we just click that and it'll appear on our watch list right over here. Now you'll see on my chart, we have BTC USD.P. And what this means is that we are trading BTC USDT futures. This is not spot trading. This is futures trading. And I don't want to overcomplicate it too much, but essentially this is what most people will use when they are day trading crypto, because it is a way to trade with leverage, which is a whole nother can of worms to open. But essentially, leverage allows you to trade with more money that you wouldn't have otherwise, because you can borrow that money from the broker, and the broker is the person that can give you the cryptocurrency in exchange for US dollars. Well, in this case, they will actually lend you USDT so that you can go and trade and hopefully make a profit. This allows you to trade and make more with less money. So you'll always see on my watch list the futures version because I day trade cryptocurrency. Not always, I do invest in cryptocurrency too, but if you are going to day trade, you usually want to look at the charts of the futures contracts. Don't want to overcomplicate it too much, and you'll see more of this when we speak about the broker and how to actually place your first trade. Okay, so that is how you add cryptocurrencies on your watch list so that you can switch between different, so that you can constantly be analyzing different types of charts. Now back to the chart. If we want to customize our chart, let's say you don't like a black background. You right click on the chart, you go to settings, and you can change that background right here. Let's say you want a white background. Tons of customization options. I'm not going to go through all of them. You can feel free to look through that yourself. Now, if we want to change the actual chart, we can right click again on the chart itself, go to settings, and we can actually change the colors of these as well. So again, feel free, go ahead and play around with those as you want. Now, lastly, in our TradingView tutorial, let's talk about how you can set alerts, price alerts. So, for example, let's just go to a very simple chart so that we can make this as easy as possible to understand. If, say, price begins to drop and you want to buy at a certain level, but you don't want to quite just place an order to buy there just yet, you just want to know if price reaches that level so that you can come back to the chart maybe at a later date and do whatever you want to do. Well, you just right click right here and you go to add alert, and here you can begin customizing your alert, such as the price at where you want the alert, the type of alert, so the condition. So for example, crossing above, crossing below, greater than, less than, tons of different ways to customize it. And you can also choose whether it's an only one-time thing or every time, and you can name it. So let's say test, and let's create it. And you'll see we now have a line at that price point as well as the name. And if we want to get rid of it, we can just hit. Now, you can actually customize that to where it sends you an email or plays a noise on your computer. So again, it's one of those things that you're going to have to customize and get used to yourself. Now, let's talk about how to actually find cryptos to trade, because we covered how to add cryptos to trade, but what if you actually don't even know the name of the crypto that you want to trade because you haven't found it yet? You are looking for a specific set of criteria. For example, a specific price point, a specific type of movement, maybe you want to look for cryptos that are moving higher or moving lower. Well, we can do that by going over to the crypto screener, bottom left of the chart. And once we hit Crypto Screener, we will see that we can actually customize everything once again. And if I went over everything you can customize, then this video would be multiple hours long. So for the sake of simplicity, we are going to use the already built-in default performance setting. So you can switch between these: overview, performance, oscillators. I personally really have never found anything more useful than the performance, because it is pretty much all you should care about if you are looking for specific cryptos. You want to see the performance of those cryptos. So we can filter by the change in the day. We can filter by the 1 week change. So we can see 11% or 12%-ish. This is the crypto that has moved the highest within the last week. The last month, we can see AVA US dollar has moved 173% higher, so on and so forth. 2,000% in the last 3 months. We got move. So if we want to check it out, we go and just click on it, and it will automatically populate onto our chart. And if we want to go into a smaller time frame, because this is a very clunky looking chart, we can start to see the price chart right over here. Okay, and it's very easy to use TradingView. Just drag the price however you want. In order to drag, I should mention that you first have to move this level, these price points right here. As soon as you move this, it'll let you free drag the chart. If you don't, it's not going to let you. So you have to move this and zoom in and zoom out. Okay, so this is how you can actually screen for different charts. So for example, if we want to know the crypto that is moving up the most on the day, and we want to trade that crypto because, well, it's moving up, then we just have to click that and check out the chart. Now this is a really ugly looking chart, so let's not trade that, but let's move on to Fort. We can see fourth USD. Okay, now we have an actual chart that we can potentially trade. So that is the basics of searching and filtering out different cryptocurrency to trade. Now, when you trade different assets, for example, let's say the stock market, you usually have an opening time and a closing time. So that is a time limit to when you can trade. But with cryptocurrency, it's different because it's decentralized. There is no one place, one entity that is controlling cryptocurrency. In stocks, it is the stock exchange and everything involved with that. In Forex, it is the central banks and everything involved with that. But in crypto, there is no bank or central exchange. It is decentralized. 24/7, the prices are always moving, always trading. So if you had to choose a best time to trade, the answer is whenever you want, whenever works for you and your lifestyle. Now, you may have been looking at this chart and thinking, wow, I still have no idea what I'm looking at. Let's change that. This is how you read a price chart, and I promise it's way easier than it might look. Every green and red, what we call candlesticks here, because I guess they look like candles. I don't really know. That's the word for each one of these little red and green things here. Each one represents a set amount of time, as we explained earlier. So in this instance, each one of these is 1 day because we're on the daily time frame. But how do we actually read and interpret what this is telling us? Because it's telling us something. Well, every candlestick paints a story. But in order to tell that story, we need to first understand what each part of the candlestick actually represents. Again, we're going to talk in candle terms here because everything that has to do with candlesticks, for some reason, has to do with candles. So we have first what are called the wicks of the candle. And the wicks are what you see right here, the thin lines. The wicks mark the high and the lowest points that were reached. So for example, in 1 day, price reached a high of $108,366.08. As you can see right here, that's the high. And a low, which you can barely see, but it is there, a low point, that is the lowest point, of $105,623. So we have the highest point reached and the lowest point reached during that day, because it is a daily time frame. If this was an hourly chart, then we could see what was achieved in an hour. The highest and the lowest points achieved in this hour most recently were 106,584 as the highest point within the last hour, and 106,106 as the lowest point in the last hour. These are the highs and lows, or the wicks of the candlestick. Now, the open and the close comprise the body of the candle. So the fat part, right? We got the thin part, which is the wicks, and then we have the actual body of the candle itself, which is the fat part here. These represent where price started at the beginning of that time frame. So if you're on a daily chart, where price started at the day and where it ended is the close. If price started lower than where it closed by the end of the day, so basically where it started, it finishes higher, the candle is going to be green. Now you can change this by customizing the colors, but textbook, usually it's going to be green because it represents an up day. It opened here. This is the opening price. Because it opened lower than it closed here. Well, that means price increased, so we see it as green. So the open is down here and the close is down there. Now, if these candlesticks weren't colored at all, or all colored the same thing, for example, if we were to color it red, well, now we actually don't really know the opening and the closing prices of each candle, because really it's about the color that lets us know that fact. Okay, so if it's a red candle, that just means that it's flip-flopped. At the top, we have the open, and we closed, or we finished the day lower than where we opened. So obviously that represents a decrease in price, and so the candlestick, or the candle body, is red. Now, why isn't the whole thing this big fat center mass thing? Because we want to know where price started, where price finished, and we also want to know the highest points and the lowest points that were achieved in that time frame as well, because that is important information to us. So we have the high point and the low point and the body all as separate things, but every candlestick is comprised of the same four components: a high point, a low point, a opening, and a close. The only difference is that the green ones open lower than they closed, and the red ones closed lower than they opened. Now, another reason why we want to know the highest and the lowest points achieved is because it gives us a sense of what happened during the day and the story that is being told in that day. So let's talk about different types of candlesticks. Every candlestick, like I said earlier, paints a picture. There are three types of candlesticks, in my opinion, the way that I like to teach. We have three types of candlesticks. We have decision candlesticks, indecision candlesticks, and rejection candlesticks. Let's start with a decision candlestick. A decision candlestick is really just a candlestick where you don't see huge wicks. So for example, this would not be a decision candlestick. In fact, this is an indecision candlestick, but we'll cover that in a second. If we take a look at this candlestick right here, or this day right here, we saw that price made a decision. It didn't have to really think much. It didn't have to go much lower or much higher and then return back to, say, where it started. It opened down here and it closed up here, and we just have these tiny wicks at the top. Very tiny wick on the bottom, which means that it barely even dropped. It really just went almost straight up, and then we saw a small back down, which is what created this tiny wick at the top. Speaking of which, let's take a look at a time frame where we can actually see these candlesticks being painted in real time so that we can get a better understanding. So let's take a look here. We can see we're on a 1 minute time frame now. That means each one of these represents 1 minute worth of time. Very small. So what do we see? We see now that price is, well, should be moving. There we go. We can see that price started up here, opened, and now it's currently here. That's why it's red. So we have a red downward candlestick. Now you can actually see that the body is the entire candlestick because it's making new lows. But once this price comes back up, you'll see a wick form because it's basically acting as like a breadcrumb trail. It's telling you where was the lowest price. There we go. Now you can see the lowest price was down here because we were just there. But now, as you just saw again, the minute just ended, a minute has passed, and we finished here within those 60 seconds. So we can see the lowest point was down here, the close was over here, and the open, the beginning, was over here. And now we have a new candlestick being formed with the next 60 seconds. If you take a look on your right, you can see the timer. So we're 30 seconds into this candlestick, and you can see we're kind of going back and forth. We went as high as up here. Oh, well, now we're making new highs, and the candlestick, or the wick, goes away because, well, the highest point is where we are right now. But the lowest point was down here. So that is how you read those candlesticks, and to give you a better example. So let's talk about the decision candlestick. The decision candlestick is basically when you see a big fat green or red candle with small little wicks. Why small wicks? Because the wicks represent where price has been in the past, but we want price to make a decision and not fluctuate too much. So this is an example of a decision candle. What is an indecision candle? Well, the perfect example is this right here. You can see that price opened right here and closed right here. Pretty close to each other. The opening and the closing price are pretty close to each other. But we had price have a high all the way up here, and the lowest point was all the way down here, which means in that given day, we saw price open here, drop as low as here, go as high as up here, and I don't know if it's in that order. Maybe it opened here, went as high as here, and as low as here. But either way, it stands to tell us a story. Price went way up and way down in one day, but finished where it pretty much started. That tells us what? The story between buyers and sellers is one of indecision. Price didn't know whether it wanted it to go up or down. It just kind of stayed the same at the end, which means that buyers and sellers are equal and nobody really knows what's going to happen. And you'll usually see these candlesticks when there's big news where people don't know what to do. They start buying, selling. You'll just see price go crazy. Or you'll see these in price movement when price is moving sideways. Because what does sideways price movement mean? If it's not going up or down, well, it means indecision. So that is when you'll see these small candles but large wicks, right? So Small bodies and large wicks to either side represent indecision. They're indecision candles. Now, what about a rejection candle? A rejection candle is when you have one long wick in one direction only. This tells a story of rejection, kind of like me throughout my whole life. An example of a rejection candlestick is going to be this one right here. What do we see? We see that price started here and is still here. This is today, so it's still moving, but we started here and we are currently here because it hasn't closed yet. It closes in 3 hours, but we got as high up as here, 108,366, but we are currently at 106,000. This tells us that price is rejecting this area. It's rejecting this price point of 108 because we got all the way up there, but we failed to stay there. That's the key component. We didn't stay there. We didn't make a decision. We came back down to basically where we started. But we don't see the same on the other side, right? We didn't really drop lower. We didn't really have a huge move down. We rallied up for the whole day, and all of it went to waste, basically, because now we're back to where we started. That is a rejection candle. And this is a sign that price may be slowing down and may be about to turn to the downside. The opposite is also true. This is a rejection candle right here to the downside. And you can see we went all the way down here. We started here, we finished here, but we reached all the way down here. And guess what we did after that? We made a decision candle here, big fat candle to the upside, and we went pretty much straight up from there. So we can actually see the story within the day because price went down. It tried very hard to go down, but it finished where it started. So it was all for nothing. It was rejected. And that tells us at the very least that buyers came in very strongly at that point, and so we saw that big move higher. And a lot of people won't really explain it that way. They'll just kind of say it is what it is. We have the highs and the lows and the bodies, and that's it. No, every candlestick tells a story. In my opinion, there's 3 different types of candlesticks. To summarize again, we have decision, which are big fat bodies, big fat candlesticks that are in one direction, whether up or down, it's still a decision. So this is a decision candle and this is a decision candle, right? One's on the way down, one's on the way up. We have the indecision candles, which are like this, or even like this. And no, that's a rejection candle. This would be an example of an indecision candle because you have wicks that are on both ends pretty much equally, right? So it's an equal battle, indecision. And then obviously this is an indecision candle as well. So indecision candles, and then we have rejection candles, which is a one-sided battle. It is a one-sided wick, where you see a wick that is, longer, much longer, in one direction only, right? So this is a rejection candle here. This would be a rejection candle to the downside. This is a rejection candle to the downside. This is a rejection candle to the upside a little bit. Not the best example, but those are rejection candles. And so knowing how to read candlesticks empowers you to be able to know how to basically read where price may be going next. It tells you the story between buyers and sellers. Now, that is how to read individual candles, but individual candles don't tell the whole story. The whole story is, well, the whole chart. How do we use the chart and analyze the chart so that we can have a decent idea of where price is headed next? Well, now comes in price action. Price action I could talk about all day long. I can't do it all in this video, but I'm going to give you again the foundation so that you can start today. What is price action? Well, price action in simple terms is price movement. So we can see the movement in price in every single candlestick, but we can also see it when you look at the bigger picture. When you look at every single candlestick put together, it also tells a story. So how do we read this story? Well, first, how do we know if price is actually moving up? And you would say, well, Corey, obviously price is moving up, can't you see? That is one way of telling. If it's going from the bottom left of your screen to the top right, yeah, you could probably reasonably say that price is moving up. But it won't always be that simple. Sometimes you'll get something that looks like this, where price is seemingly moving sideways, and you don't really know whether price is moving up or down. And you may be saying, price is moving sideways. But I don't think that's correct. I personally always think that price is technically moving in one direction. It's always moving either up or down. There are 2 ways price can move. It can either increase in price or decrease in price. It can stay the same, but eventually it's got to move one way. So how do we know where it's most likely to move, at the very least? Well, we can do that with a set of rules. So how do we actually define uptrend and a downtrend? Well, it's pretty simple. An uptrend is defined as higher highs and higher lows. Just like this, we're making higher highs than the previous highs, and we're making higher lows than the previous lows. This low is higher than this low, therefore we are in an uptrend, and this high is higher than this high, so again, therefore we're in an uptrend. A downtrend is the exact opposite, lower lows and lower highs. So this high is lower than this high, so we're in a downtrend. This low is lower than this low, so we're in a downtrend. That's the only way price can move. It's either making higher highs and higher lows, or it's making lower lows and lower highs. It's always either moving up or down, technically. So let's see this in action, and let's actually use it to define whether we're in an uptrend here or in a downtrend. So in this instance, you would say, well, you have a high here, right? So let's mark this. We went high, we went low, we went high, we went low. So we're making new lows and lower lows. That means we are technically right now in a downtrend. But then we start to kind of do this. Well, that starts getting confusing, doesn't it? Are we making higher highs, or are we still making lower lows? The way that I would define it is that as long as you don't break this high here, this is the swing high, as long as you don't break that, we are still in a downtrend, right? So whereas someone might say that this is consolidation, I would say that we are still in a downtrend. Just makes it easier. Once we break through that high, as we did right over here, now we are in an uptrend. And obviously we can see price went on to make a huge move to the upside. But most people would get confused here. They would say, well, price made a high, it made a low, it made a high, it made a low, and then it made a high here, and then it made a low here. Oh, but then it broke this high, so we must be in an uptrend. And even though that did work in this case, right, because it pulled back and then continued on higher, in many cases, this won't work out, and you'll actually continue lower because the swing that you're actually trading is still in a downtrend because you never broke through this previous high. You only broke through this previous high, and this is what we call a complex correction. Even though it may look like we're making new highs, what we're actually doing is just correcting as a bigger part of this initial move down. And again, even though it didn't work in this scenario, this is just an example, this is usually the best way to look at it. So that is how you define a downtrend and an uptrend. As long as you are making lower lows and lower highs and not breaking those established highs and lows, then you are in that trend, whether it's up or down. Lower lows, lower highs, higher lows, same thing. You get the point. Now, there are instances where price does move sideways, and the only time we actually consider price to move sideways is when it benefits us for a trading strategy known as a breakout. A breakout is just when price starts to move sideways and breaks out in one direction, and so we use it as an entry signal. So let's talk about consolidations and breakouts. Now, what are breakouts? The only scenario where we can recognize prices moving sideways is if we are trading breakouts. Because as we'll see later on in this video, there are two different strategies that I'm going to show you. One is trading these swings. And when you're trading this up and down swings, lower highs, lower lows, all of that, you don't really want to consider price to be moving sideways. It never really is when you're trading that way. But if you are trading breakouts, which is more like momentum trading, where you're trying to capture a big move in one direction, then we can consider sideways price movement. And it's going to look something like this. This is XRP, or Ripple, a cryptocurrency. And this is the daily time frame. And what you want to look for in a breakout scenario is something like this. A big move higher, at least for the bullish case. And then you can see we start to get a lot of those indecision candles. So the range begins to tighten up. We begin to move sideways. And this isn't even a good time frame to look at it. Let's check the 4-hour time frame. It'll be an even better example. Yes, there we go. So we see this big run up higher. Okay, and then all of a sudden, we pretty much begin to go back and forth, back and forth, back and forth, until we almost flatline, basically, with a whole bunch of indecision candles. Now, this is where we can say price is moving sideways, because what is it doing? It's getting ready for the next big move higher. That's why it's indecision. Nobody knows whether they want to buy or sell, and usually this is a sign of a break or a pause because sellers are selling at the higher prices because price just ran up a ton. So once these sellers begin selling, you start to see this sort of flatlining because the buyers are still buying, but the sellers are selling at an equal rate. So we begin to see a flatline. But once those sellers are done selling, usually because they're taking profits, well, the buyers are still buying. They still are going to push the price higher. And this results in what's called a breakout. A breakout is when you begin to flatline like this and you break out of the top range of that trading range. So in this case, we have the highs over here. So let's mark that with a horizontal ray, and then we have the lows over here. So you can see price was bouncing back and forth between high and low, high and low, high and low, high and low, over and over again. And once we break from that high, that is known as a breakout, and this is where you want to buy. So these can work pretty well, but there are certain criteria that you have to follow, and we are going to cover that later on once we actually dive into the full strategy of breakout trading. For now, let's continue talking about actually analyzing price action, trading these swings, the highs, the lows, and everything in between. I'm going to make an entire video on price action trading alone because it is worth talking about in great detail, but let's talk about one of the 3 P's of price action, pullbacks. Now, as the word entails, is just a pull back from a high or a low. So in this same example, we can see that we have a few examples of pullbacks. We have a move lower, a move higher, a move lower, a move higher, a move lower, and then a move higher. Now, pullbacks can tell us a lot more than just the fact that price is pulling back from a move. They can actually tell us whether we are likely to continue in that direction of whatever the trend is at the moment, reverse. And a great example would be the example that we just looked at over here. We saw a move higher, a move lower, a move higher, another move lower to a new low. So we have a lower low, a lower high, and a lower low. So we are in a downtrend. Now, let's take a look at the pullback. Well, we saw a pullback to right around here initially, right? So let's go back here using the replay feature on TradingView, which is right here. We see that price pulled back all the way up here. Well, that tells us something pretty interesting. Why? Basically, what we see is that price pulled back pretty heavily, right? We have the high here, and we reached pretty much, just very close back up to those highs. What does that tell us? It tells us that, well, price is pretty strongly reversing off of where it's coming from, the lows, because we're almost back to those previous highs. And the way that we made this new low, you can see, was a pretty sharp drop, and this is what's called pitch. So we saw a big, strong move down, and it was pretty much for nothing. In fact, we saw this big rejection candle, and now we're almost back up to new highs. In this instance, we probably should have expected a small pullback, something maybe like this, right around here. But what ends up happening is we surpass that and get right back up almost to the highs. This tells us that the pullback wasn't shallow, it wasn't a small pullback, it was in fact a large pullback, and a pullback that indicates that buyers are kind of beating the sellers to what we would expect. In this case, we would say, well, the buyers are stronger than what we thought, and so this swing here, we probably don't want to short this. We don't want to bet against this. We probably are going to see a reversal to where we break through these highs here because of what we're seeing with that deep pullback. And as we all know, once we actually get moving, we try to come back down, and exactly as expected, we break through those highs and we see a huge reversal. So the moral of the story is that a shallow pullback is expected when price is moving very strongly in one direction, very sharply in one direction. You're expecting small pullbacks, and you should trade small pullbacks. You should look for small pullbacks. If you see a very sharp price movement like this, and then you get a very big move back down, almost back to where it started, That tells you that that price action is telling you that price is actually not doing what it was supposed to do, not continuing in the direction it wanted to continue in, and therefore you might expect it to fail. Bitcoin, as an example, lately on the daily time frame, we saw this big move higher, and what are we getting? We're just getting these small little pullbacks. That's an example of a strong uptrend. If Bitcoin were to come all the way back down to this low point where it started this move, that would probably tell you we're not going to make a higher high from there. More than likely, what we're going to do is have a little bit of a, farting around and then probably continue lower. Again, I could talk about price action all day long and I'll make a long video on it, but this video is already over an hour. So I'm going to leave you with that preview of price action, but don't worry, I'm still going to give you 2 free strategies. This is just to help you kind of understand how the market works a little bit better. Now, you know a little bit about breakout trading and how that works. You know a little bit about swing trading or trend trading and how that works. Let's put it all together and actually talk about strategies. Now, before we talk about strategy, I'm sorry to tease you again, but don't click off this video because this is probably the most important part of the entire video. Before we talk about strategy, we have to talk about what makes a good strategy and how do you actually go and build your own strategy. And what is going to be the key is going to be 2 core concepts. Risk to reward, which is what we covered earlier, risk to reward ratio, and your win rate, how often you actually win. So let's talk about the relationship between risk to reward and win rate. What makes a great strategy? Well, a great strategy can be a mix of a bunch of different types of risk to reward ratios and win rates. But let's talk about the 3 most common strategies. 1, you have the strategy that has a high win rate, but a low, let's say 1 to 0.5 risk to reward. Now, this would be a very, very profitable strategy, but it's just going to be an example for right now. A win rate of 90% with a risk to reward of 0.5%. This is a very high win rate. You are winning 90% of the time, but the trade-off is that you are risking $1 to make 50 cents every time. So you have an inverted risk to reward ratio, but this is still profitable. Despite the fact that you are making less than you risk per trade, you're risking $1 to make 50 cents, you're winning far more than you're losing, and that offsets the difference. And we're going to visualize this in a second. But that is the first strategy that we'll talk about because most people are obsessed with this type of strategy because they only want to win. But that's not the only way to actually make money. You don't need to constantly be winning to make money, as we'll see in a second. The second type of strategy is a decent win rate, let's say 55%, and a decent risk to reward, let's say 1 to 1.3. So in this example, your reward is greater than your risk. You're making 30 cents for every dollar, or $1.30 for every dollar you risk, but now your win rate is a little bit lower than 90%. The trade-off is that you have a decent win rate. You're winning more than half the time, a little bit more than half the time, and every time that you're winning more than what you risk. So your win rate to risk to reward ratio is still profitable. And again, we're going to visualize this all in a second. Now, the last type of strategy is going to be a low win rate strategy, high risk to reward ratio. Now, these are some of the most fun strategies, and you'll see, we'll give you an example of both of these today with our strategies. But this is an example of a trader that is winning very, very little. Very few times are they actually making a winning trade. But when they do win, they are making tons and tons more than when they are losing that money. Now, let's visualize this with some graphs. So here we have an equity curve simulator, and let's say we start out with $100 in our trading account. Now let's talk about our relationship between risk to reward. So in the first example, we have a 90% win rate and a 0.5 risk to reward. So let's put in those numbers: 90% win probability and a 0.5 risk to reward. And let's say we take 100 trades, and number of lines, we'll just do 1 for simplicity. And let's say we risk 1% of our account per trade, which is what you should be doing. Never risk more than 1% of your account. This is a huge, huge, huge important part of this entire video. You don't want to risk really more than 1, maybe 2% of your account every trade you take. And if you're a complete beginner, you probably shouldn't be risking more than 0.5% of your account per trade if you're day trading. It's a little bit different if you're investing. You can risk a little bit more, because if you're investing for the long term, you're more likely to win. There's less risk overall. Things tend to move higher in the long run. But in this case, we don't want to risk more than 1% per trade. So let's start the simulation. So you can see, obviously, as many of you would expect, if you're winning 90% of the time and you have 0.5 risk to reward, you're going to pretty much have a straight line up. It's a very good strategy. You're winning so much that even though you're making half of what you're risking, you're winning, almost 100% of the time. So you're going to have a nice straight graph like this. So now let's put in the second strategy, 55% win rate, but a 1 to 1.3 risk reward, which I don't think this is actually going to be that good. It was just an example, but it should still be profitable. And 200 trades, number of lines 1, and 1% risk. Sure, there we go. Now, yeah, pretty good. We're just running multiple simulations, and most of them are pretty profitable. So now, again, profitable despite only winning almost half the time. And we're only winning a little bit more than what we're risking most of the time. And it is still profitable. You can see in this simulation, it ended at around 200. So we made a return of 110%. Okay, pretty good within 200 trades. Now let's go to the last one. Let's do 25% win rate. And I know the beginners that are watching this are thinking, oh my God, 25%, I would never trade that. Well, it's all about the win to loss ratio. So we don't even have to do 9. We can do 7 to 1. Let's say we make $7 for every dollar we risk, and we win only 25% of the time. Keep in mind, that is 2.5 trades for every 10 trades you take. You are losing more than 70% of the time. Let's see what happens in this simulation. You can see it is, again, profitable. And in fact, it is more profitable than the examples we were looking at with the higher win rates. You can see we're making 1,000% return. Now, this is a very unusual combination. Most traders won't be able to achieve something like this. It's usually only achieved with one of the strategies I'm going to give you today. But this is just one of the examples, the fact that you don't need to win a lot in order to make money. You can win, but win big. And let's even test this out and go lower. Let's say we will win only 15% of the time, and let's turn this up to 8. Let's see what happens then. It's still overall a profitable strategy. So there are many different ways to skin a cat. These are the 3 most common types of strategies that you will see: high win rate, low risk to reward; medium win rate to medium and low win rate; and high risk to reward. How do we actually get that data? Well, you're going to want to use one of TradingView's best features, which is the paper trading and backtesting features. So as we saw, we can actually use TradingView to go back in time. So what you're going to want to do with the strategy that I give you today is backtest it. How do you backtest it? This means testing it out, but without risking real money. 2 ways. 1, you can go back in time and look at the chart's previous performance. So what we're going to do is go to the replay feature here, and we are going to go back in time. And now we have a chart that is in the past, but it looks like it's today, right? Because there's nothing to the right of it, right? We only are at here, which is back in February of 2020. So now what you can do is actually play this forward by clicking forward. And now what you can do is follow the rules of your strategy. So for example, if we're trading breakouts, right? We would look at this and say, okay, we're starting to see some, right? We got that big move higher, and now we're starting to see that consolidation, that indecision, that range, right? Highs and lows. So this fits our rules for a breakout pattern. So what are we going to do? Well, let's put in a theoretical trade. Let's get our risk to reward long position. Let's put it above the highs of this trading range, because that is where we want to buy, because it's a breakout of that range. Our risk is going to be below the lows of this range, and our reward is actually going to be undefined as of right now. And I'm going to explain why that is once we get into the actual strategy of breakout trading, but this is just how to test strategies as an example. So let's just put it up here for now. Okay. Now we're going to play forward, and now you can see that technically we would be in a buy position. Now you can either just keep this where it's at, right? You can keep this long position risk reward ratio where it's at and manually record, you would have entered here, the risk was down here, and actually it should have been probably down here a little bit lower. You can manually write this all down in some paper or document, whatever you want, or you can also use the buy and sell feature on TradingView, in which case if you do, and let's actually go back a little bit just so we can buy. you can only, as far as I'm aware, you can only buy at the close of the candle. So we actually would get a worse entry point if we do hit buy. And the quantity, let's say we want to buy 1 Bitcoin. If we hit buy, well, now we're going to have an entry point that's here rather than where we actually wanted to buy, which is here. So TradingView makes it very easy to put in your stop loss. You go to SL and you just drag it to where you want to go, and take profit, TP, and drag that where you want it to go. And now you are technically in that trade and you were back testing, right? So now we're just going to let this go. You can actually hit play and it'll play. I'm on 10x speed, but you can move this to whatever you want. And let's hit play. And you can see price went up, hit the take profit, and we are good to go. So this is how you backtest. You go back in the charts and you just basically trade as if you're trading, but you're doing it in past charts. Now, ideally, you want to go to an area where you don't know what's going to happen, okay, so that you don't, have a bias. But that is one of the features that TradingView allows you to do, is the paper trading and backtesting features. Now, once you actually go back in the charts and test out your strategies using the backtesting replay feature, you then want to open up a paper trading account. So a paper trading account is basically just a fake money account. Basically, you're just practicing. It's not real money, but you can basically do all of the things you would do in real trading, but with fake money. Okay? How do we do that? Well, we go down to the bottom left again here. We click Trading Panel. In Trading Panel, we are going to see a list of different brokers, and we are going to go to Paper Trading. This is the account that TradingView is going to provide you so that you can practice your trading. You hit connect, and now we have a fake account of $100,000. So now what we can do is actually trade with this $100,000. And if you want to mimic your account size, let's say you have $10,000, you want to go here to the little settings icon here, and you want to hit reset account. And then you can actually input whatever you want. So you can put in $10,000. You can actually even put in the currency that you want to be trading in, so for the global friends out there. And then you can actually set the amount of leverage, which I'm not going to get into here, but usually you just want to keep it the way it is. Hit reset, and now you have a $10,000 account. Now, how do you actually use the trading features? This goes for both paper trading and real trading. If you are connected to TradingView, you can easily just trade right onto the charts. So how do you do this? Well, TradingView makes it very simple, just like we did with the replay function. Let's say if we want to place a trade, let's go on Bitcoin to the 1 hour time frame. And let's say that we want to place a trade here at $105,000. All right, so let's visualize that. We're going to enter here in the middle. That represents our entry. And then we are going to want to put our stop loss, let's say below this low point here, and to take profit at the high point, let's say. So our risk reward is 1.8, which is pretty good. Now, if we want to actually buy at this level, we don't need to wait for price to come down here and then we hit buy. We don't need to do that. Right here, you can see sell and buy. We don't need to hit those necessarily. What we can do is place what's called a limit order. There are two different types of orders, and you're going to see this when I show you the broker. But there are two different types of orders, and as long as you understand these two types of orders, you don't really need much more. There are limit orders and market orders. Pretty much. There are different types of orders, but for a beginner and even intermediate, that's all you really need to know. All you have to do is right click here on where you want to potentially buy that, well, where you do want to buy Bitcoin in this instance, and you're going to hit trade right here, and you're going to hit buy. Now, you're not done yet. We're going to put our stop loss to where we want it to go, just like we said we would right here, and our take profit, we're going to drag that up here. Okay, we also want to make sure that we're not risking more than what we can afford to lose, right? We have a $10,000 account. We should not really risk more than 1% of our account. So how do we make sure that this trade is going to follow that, so that in case we get down to the stop loss, we aren't risking more than 1%. So we want, if price blows through our order and we buy here and price, comes all the way down here, we want to make sure that at the max, we lose 1% of our account. How do we do that? Well, we're just going to right click right here, edit project order, and we're going to go here. You can customize all of this, but really this is the main thing you want to be worried about, is the risk percentage. And you can even change this to US dollars. Okay, risk percentage, we want it to be 1%. If you hit 1%, now it's going to actually adjust everything automatically for you. And you can even see your risk reward as well here. So you don't even need this tool if you know exactly where you want to put, this is just a visualization tool. But once you actually put in your stop loss and your take profit and your order, then it'll actually just tell you your risk reward here. But now we can make sure that this trade, if it comes down to here, we are only going to lose $99.87, or about 1%. of our $10,000 account. Now we hit buy, and what's going to happen is that it's going to place a limit order. A limit order just means that you are placing an order that is not at the current price of the market. So Bitcoin is currently at $106,673. We need to place a limit buy order because we want to buy at a lower price. Now, this is what's called a buy limit order. Now, let's say we wanted to buy at current price. We would actually use what's called a market order, in which case we would just hit buy right here. You can see it says buy market, and this is what's called the market order. So this would actually execute at current price. Now, I'm not going to do that because I don't want to take that trade, but if you want to buy at current price, you use a market order. If you want to buy at a different price, lower than current price, then you use a limit order. Now, there's something called a stop order. A stop order is an order that can do two things. It can either stop you out of a losing trade, which is why it's called a stop order. So if you are placing a buy limit order, you're going to need a stop order or a stop loss, as you probably have heard if you've done some trading. A stop loss is just an order that makes sure that you are selling at a loss. Stop your losses there. This right here is a stop loss order or a stop sell order. Now, there are a ton of different order types, but all you really need to know, especially if you're a beginner, TradingView will put in all the orders for you automatically if you trade on the charts. And most brokers will help you out by just asking you, where do you want to buy and where do you want to sell for a loss and where do you want to sell for a profit? So with these two tools of the replay trading and the paper trading, you can now go and test out your strategies and see how much money they make. On average, how much money are they making when you win? How much money are they losing when you lose? And you can keep track of all of this and start to calculate your average risk to reward and your average win rate. Look at the trades that you win, look at the trades that you lose, add them all up, and get the numbers, right? Your win rate is going to be the amount of times you win in a given amount of trades, and your risk to reward is going to be, on average, how much are you risking to how much are you making. Now, I would recommend at least 30 to 60 trades in back testing. So go back into the charts and test out your strategy, run the numbers, and see in 30 to 60 trades, did you make a profit or did you lose net? Once you see 30 to 60 trades in the back testing, and you see some sort of consistency, you can move on to the paper trading. So you can actually move on to paper trading where now you're not trading previous charts or the past, you are now trading the future, but with fake money. So now you can actually move on to trading in real time, because trading in real time is much different than trading the past. If you see that you're paper trading, you're trading your strategy, you have all the numbers, and you see that 30 to 60 trades in paper trading, in real time trading with fake money, if you see that after 30 to 60 trades, you are still profitable with the same strategy, now that is when you can go and open up a real account. All this time we have been on the charting platform TradingView, but now it's time, if we want to actually start trading real money, we need to go and open an account with a broker where we can actually buy and sell cryptocurrency. There are hundreds, if not thousands, of crypto brokers out there, so I'm going to make it very simple for you. I personally recommend Phemex. Phemex is very easy to use, and the one thing that I love about it is that it's available to United States customers. A lot of cryptocurrency brokers are not available to customers due to different regulation reasons, but Phemex, as far as I'm aware, is one of the easiest brokers to use if you are located in the United States. So let me show you how to actually start trading on Phemex. I'll put a link to open a Phemex account in the description down below so that you can go and open your account and follow along. It takes maybe 5 minutes max to go and open your account. And so you might want to pause the video, go open your account, and once you do and you have everything set up, very easy process, you're going to go to contract, and now we are going to have access to a screen that looks something like this. This is the Phemex platform. Now, like we were talking about earlier, there are two different ways you can trade. You can trade futures, which are going to be under contract, and you can trade spot. Spot trading is where you aren't using any borrowed money from the broker, which I'm going to explain here in a second. Futures trading is where you are basically trading a derivative of the crypto, because you are speculating on a contract of what the crypto is going to be worth in the future. I know it sounds confusing, but basically all you need to know is that spot trading, you trade with whatever money you got. If you have $1,000, that's the maximum amount of money that you can put into any given trade. If you trade futures, like me, you are going to be trading borrowed money that can be used to trade more than the $1,000 that you have. So for example, if you want to have access to more money, you're going to go to this right side right here, and this is what's called leverage. Leverage is going to be shown to you in a way that looks like this. So leverage long and leverage short. It's basically how much money you're borrowing for your buying trades and your selling trades. So let me try to make this as simple as possible. You're going to want to usually keep these to about 10x maximum. This means that when you are looking to buy Bitcoin, you can buy 10x the amount of money you have in your account, maximum. If you have $1,000, you can technically trade $10,000. Why would you want to do this? Well, if you only have $1,000 and you want to trade, for example, the 1 minute time frame, you're going to be very limited to how much money you can make on the 1 minute time frame because you don't have much money to trade with. So for example, if you want to trade something like the 1 minute time frame on Phemex, but you only have $1,000, well, if you only have $1,000 and you want to trade the 1 minute time frame, and this is actually TradingView, by the way. So let's say you want to trade on the 1 minute time frame with $1,000. And let's say you want to buy right here where price is at currently. If you use $1,000 and you say you want your stop loss to be down here below these lows, that is only a 0.32% move to the downside. So that means that even if you put in all $1,000 that you have to your name into this trade, and then you put your stop loss here, well, you're only able to lose negative 0.32%, which is $3.02. You want this number to be 1% ideally. So you need more money to trade with so that you can risk more money so that if price goes in your favor, you can make more money, right? Because we want to risk 1% so that when we win, we can make more than 1% potentially. So how do we do that if we only have $1,000, right? Well, you can use what's called leverage. So let's do the same exact trade now, but let's now use 10x leverage for both our buying and our selling. You're going to want to keep them the same. Don't overcomplicate it. Just keep them the same. This means that we now have access to up to $10,000 theoretically. We can trade with $10,000. Let's just say we want to buy at $106,000 a coin. Okay, well, we're going to come here and now we have 10x leverage on both ends. Don't do 100x. You are probably going to blow up your entire account. Never exceed over 10x. In fact, if you're a complete beginner, you might only want to do, 2 to 5x, maybe not even 10x, but proceed with caution. Now, what we're going to do is, let's say we want to buy at $106,000 a coin. Okay, so now we're going to give the size. How much do we want to buy? Let's say we want to buy $1,000 worth. That is going to cost us 96 USDT. Why is it going to cost us $96 if we want to buy $1,000 worth? Because we have access to 10x our money. Every dollar that we put in, the broker gives us 10x of their own money to trade with, so that we can both stand to lose and gain more money. It basically just allows us to trade with smaller amounts of money, but make the same amounts as we would if we were to trade with larger amounts of money. So it's going to only cost us $100 basically to buy $1,000 worth of Bitcoin. Now, if we were to change the leverage to 2x, watch as the price increases. We're going to confirm. Now you can see it's going to cost us $477 or roughly $500 or roughly half of $1,000 because 2x. They're going to give us 2 times whatever we put in. So we only need to put in $477. So ideally, what you want to do is use leverage just enough so that you can risk what you want to risk per trade. So if you want to risk 1% of your account size per trade, then you're going to want to use a position calculator. So here's an example of a free position size calculator. Let's say we have $1,000. We want to risk 1%. Now we have to see, where do we want to enter? Let's say 6,272. And our stop loss, let's say, is going to be 106,035. So that is 106,000. And our risk is going to be 1%, so $10. Entry fee and stop fee percentages, don't have to worry about too much. They're going to be minuscule. And now we're going to hit calculate. So we need $4,479 to take this trade in order to risk $10. So what we would have to do is make sure we have enough leverage, right? If we have $1,000, we would at least need 4x leverage for this, right? At least. And now we would just put in this number right here, copy and paste, 4,479, right? And we would place that in the size portion there. Now, price has obviously moved, and it probably will continue to move. So you're going to want to probably put in a little bit less just to be safe if you're trading a really fast time frame like this. So probably $4,000. And so now you'll see that this is going to give us enough money so that if price moves below this low, we'll lose a maximum of $10 or 1% of the $1,000 we have to trade. And if price goes higher, well, we stand to gain more than $10 probably, right? If we're targeting up here, our risk to reward is going to be good, all of that. So that is how you calculate your position size, and that's how you use leverage. This trade would not be possible if you did not use leverage. So in order to create a stop loss and take profit, you would want to, if you're buying, use the long option, and if you're shorting, and that means making money on the way down, you would use the short option. But we've really only talked about buying positions, so let's use the long position because we did want to buy this, right? And then we would just put in our stop loss here. So let's say, again, we want to be stopped out at this price here. Copy and paste that. For take profit, let's just say 106,800 right up here. Okay. Now it's actually going to give us what we stand to make and what we stand to lose. $20 we stand to make, and $8 roughly is what we stand to lose. So that is exactly what we wanted. Now, if price reaches this level, if we open this position and price reaches this level, we are going to be stopped out and lose $8. If price reaches this level, we are going to sell and make this amount in profit. So easy enough. You would just hit open long, and there you go. Congratulations, you placed your first trade. So that is how you use Phemex and the leverage. It's pretty intuitive. There's probably more that I could talk about, but again, I don't want to make this video too long, even though it's over 2 hours now that I've been recording this video. So now let's talk about the actual strategy, because you now know how to paper trade with fake money. You now know how to trade with real money over on Phemex. You know how to open your positions. You know how to calculate risk. You know how to calculate your position size. Now, let's talk about actual strategy. How do we actually make money trading with proven strategies? So let me share with you 2 different types of strategies that you can start trading with as soon as today. So now that you have all of that knowledge, you're ready pretty much to start trading. So strategy number 1, it's going to be the breakout strategy, which we've already discussed, but how do we actually implement it? So the breakout strategy is going to work like such. You're going to look for charts that look like this, but you're going to need 2 indicators to help you out: the 10 and the 20 moving averages. To add these indicators to your chart, go to the indicator section, go to moving average simple, click on that, and click on it twice and add 2 of them to your chart. Go over here to the little cog section here and set one to 10, and go to the other one and set that one to 20. Now you have these 2 lines on your chart. You are going to look for cryptos that are moving much higher. Well, how do I find cryptos that are actually moving higher? You go to your crypto screener. So go to your crypto screener, and let me move my head for a second here. Go to your crypto screener and shuffle through all of these. You're just going to shuffle through the top gainers of the day, of the week, of the month, of the 3 months, of the last 6 months, etc., etc. Shuffle through all of them and really only focus on, the first 10 or 20. You don't really got to go through all of them. Eventually, what you're going to find is that some of them on the daily time frame are forming pattern right here, a flag pattern. So you are going to look for a price chart that looks something like this. There are a couple rules you have to follow. 1, it has to have moved 30 to 100% in the last 3 months minimum. This ensures that it's in an uptrend and that it's actually moving enough to where it's worth your time. If you don't know, this strategy is actually taken from a millionaire Swedish trader. I don't think he's actually Swedish, but I actually tried out his strategy in an older video. I tried a millionaire trader strategy. Go watch that. It's on my channel. And this is the exact strategy that he uses. So 30 to 100% in the last 3 months, or just a big move like this in general. If you really want to simplify it, a big move like this and then a tightening range. You want price action to start moving sideways, almost flat. The more flat, the better. So those are the first couple of rules. Now, you also need to make sure that it is trading above the 10 and the 20-day moving average. If it is trading below any of these moving averages, you will not be trading it, because the strongest moving cryptos and stocks, and even in Forex, the strongest moving charts are always trading above these 2 lines, 10 and 20 moving averages. Now, you're going to wait for this consolidation, and even on a 4-hour time frame might even be better. Okay, you're going to want to look for something like this. Now, it is falling below the 2 lines here, right? It's kind of trading in and out of it. That's okay. You just don't want to see it do something like this. Once it's like really down under these and they're starting to turn down over, then this would be negated. But you want to see something like this, a big move higher, and you also want to see that tightening range where you're kind of getting that flattening, but you also want to make sure that you are making higher lows. This is important. If you are making lower lows, that means you're basically going like this and going like this. You don't want to trade that. You want to trade something that looks like this and it's going like this, basically. Okay? Flat, but still making higher lows. So you want higher lows and you want a tightening range. Once we break out from the highs, so in this case, just to make it simple, technically would be here. I would argue that you would want to look for a breakout probably around here or even here. Either way, the idea is that once price starts breaking out of its tight range, let's see if it does that. So in my opinion, I would have personally, not to hindsight trade, but that is enough for me to enter this trade. And you're going to enter on the close of that candle, especially if you're new. If you're experienced, you can put a buy order there. You're going to enter on that candle and then you are going to put your stop loss usually below the low of the range. In my opinion, is the safest bet. Now your target is going to rely on these lines again. Your target is actually not going to be a set target. You are going to wait until price breaks below the 10-day moving average after it continues moving higher. So once we start continuing higher, you can see that the moving averages increase because the average price is increasing, right? So once price starts trading below the 10-day moving average, or in this case, it's 4-hour chart, so 10 4-hour bars, the red line, as that's the simplest way to put it, the red line. Once price starts trading below the red line, then you are going to sell. So that's going to be your target. So we would have sold right there. In this case, this wasn't the most amazing trade. It was a 2.5 risk to reward. Still good, but ideally you would probably want to trade this on the daily time frame. Usually for crypto, you want to trade on the higher time frames, daily and weekly charts, because cryptos make their biggest moves on those time frames. Now let's see what happens if we were to, in this case, since it's the daily time frame, we probably would wait until we break this high right here or even this high. Okay, for example's sake, let's just say we bought here, stop loss below the range right around here, and target is below this red candle. Okay, now obviously if it comes down here, we're gonna get stopped out, but you get what I mean. Watch. Okay, we're gonna see boom, and look at how it came back down to that red line and immediately rejected it and continued higher. Okay, now we're not gonna sell until we trade below that red line, which is right there. And so now that is a much better trade because daily time frames tend to move better. And you can see that is a 4.45 risk to reward trade. Okay, so that is strategy number 1. Breakout trading on the daily time frame using the crypto screener to find those high flying cryptos. Now for this style of trading, it's going to be an example of a high risk to reward but low win rate. You can probably expect to win about 25 to 30% of the time, but your risk to reward can be as much as 10, 20, 30x. Okay, so for this style of trading, you might want to risk 0.25% of your account because you're going to be losing more often than you win. You don't want to use, for example, 1% and you lose 10 in a row, for example, which will happen with a strategy like this. Then that's going to be 10% of your account. You don't want to lose 10% of your account. I would say 0.25 to 0.5% of your account with this type of strategy. Now, our next strategy is going to be a day trading strategy. So the first strategy is on daily to weekly time frames on crypto. It's high flying crypto. This is a great strategy for meme cryptos or just cryptos in general, right? Altcoins, it's a great strategy for altcoins that are exploding. Even Bitcoin on the weekly time frame, I've had great success in investing in Bitcoin using that breakout strategy. Now this strategy is going for the smaller time frames. It works particularly well in the smaller time frames because on the smaller time frames you get a lot more back and forth, right? You don't get straight moves as much. Sometimes you do when there's news and stuff like that or big whales, but for the most part you're getting nice ebbs and flows on the smaller time frames. So smaller time frames being the 5-minute to even the 1-minute time frame. Again, don't leverage too much money on these small time frames because they can move huge unexpectedly. So make sure you're not, placing no stop loss and 100x leveraging your account, right? Don't do that. This is going to be more of a price action trading style/strategy. Now, what you're going to want to do is you are going to be trend trading. Wait for price to make a new high. And for this example, it's going to be buying, but everything that I'm about to tell you, if you just inverse it, you can do it for shorting as well, betting against the market. But if you're a beginner, I assume you're really only going to be familiar with buying at first. So let's do a buying example. So right now, we are currently technically in a downtrend. Why? We made a new high here. We made a new high here, right? High, low, high, and we broke through this low here. Okay, so now we're technically in a downtrend. We're not going to trade it. We're going to wait for an uptrend. So what constitutes an uptrend? If we break through this high, so let's just break through that high. Okay, there we go. And now we have a higher high, right? Okay, perfect. So now we are technically in an uptrend, right? So what we're going to do, if I can get rid of all these drawings, what we're going to do, we have broken through this high, right? So we made a higher high. So now we can expect a higher low. So we're going to wait for a pullback. Now in this case, we made a new high in a pretty strong way. We went almost straight up, big decision candles. So in this case, we're probably going to expect somewhat of a medium pullback. So probably back towards the middle of this big swing right here. Okay. Now, how do we measure this out? Well, there is a cool tool called the Fibonacci retracement tool where you can take from the low to the high. You will get these different percentages right here. These are different Fibonacci sequence numbers. Not going to explain what that means, but it's basically some natural phenomenon that happens in nature. If you've heard of the Fibonacci spiral, it's kind of like that. It's related to that. What I like to use it for and how I like to view it is that each of these levels represents a percentage of the pullback back down to where it started. Okay, so this is 100%. Why? Because from the highest point it reached to where it started, it pulled back 100% of the way there. Now this is 38%, basically 382. You can copy these levels. It's a Fibonacci number. That represents about a 38% retracement, a move back down to where it started, to where the swing started, right? So about a third of the way down. So if we're expecting a halfway point pullback, okay, what we're going to do is we are going to use the 50% level, the 50 to the 61. We're going to draw a box right in there. So you're going to do this for every swing high that you see, a new swing high. You're going to identify the trend, and then you're going to mark out of the current swing high. You're going to go high to low with the Fibonacci retracements, and you're going to draw this box, 50 to 61.8%. And what you're going to do, very simply, is you're just going to put your order right there at the 50% level. You're going to put a stop loss below this low down here, and your target is going to be the following. Delete this Fibonacci retracement because we don't need it anymore. We got our entry point. Your target is just going to be a copy and paste of that line right there. So draw a line from high to low, copy and paste it, and you're going to paste it to where you're entering. Okay, right there. Okay. It's an equivalent move higher. This is what's called an ABCD pattern. I can't go over it in this video. I'm sure you'll see it in a future video. And if you have been watching me, then you've seen it in the past videos. Thank you for supporting me. All right, this is what you're going to want to do. A 50% retracement, halfway down mark. Place your order right around there. If you want to wait for a little bit of confirmation, maybe you can wait for a rejection candle in this area. Maybe it would be a good idea, right? Now we're getting a little more advanced, but okay. And then you're going to just take a copy and paste line from low to high. You're going to copy and paste that line and just put it at your entry point. Now, that's your target, and if price goes below your entry point, you're going to keep moving this lower, right? So you'll see, I think, let's see what happens here. We're going to go forward, and let's see if we can reach that area. Okay, so now we actually made a new high. We need to take Fibonacci retracement, high to low, and now our 50% level is right here. So there's our box right there. Okay, and that is going to be where we're looking to enter. Okay, so the entry point is going to be right around here, and the stop loss is right around there. And now we need to take that ABCD pattern from low to high, copy paste that, Control C, Control V for those of you that don't know, copy and paste. And now this is our target. Okay, right up here. Okay, and now let's see what happens. So if this goes lower, we're gonna have to move this lower, right? Because it has to be from the lowest point of this swing. So if price went lower down to like here, then we would move that target. We would move our target lower to compensate for that, because it needs to be an equivalent move higher from the last low, if that makes sense. I may be losing some of you, but we're gonna keep going. Here we go. Let's see what happens. Okay, there you go. And actually we did move a little bit lower, so technically our target would be probably a little bit lower, but it for the most part hit our entry point and went to our target. And look at that. Look at how it was almost the perfect target. It was a 1.73 risk to reward. Following the advantage of the strategy is that you're always following the trend. You're entering at a relatively good place almost every time because it's just a halfway mark, and then you're only targeting an equivalent move higher, so it's something that the market has proven that it can do already. So that is strategy number 2, the trend trading strategy on the 5 to 1 minute time frame. Now, I have sat here on this chair for over 2.5 hours. I hope that this video is not that long after I chop it up. If you enjoyed this video, please, I'm begging, subscribe, like this video, leave a comment down below on if you have any questions. Did you enjoy? What do you think? Let me know in the comments down below. Make sure to get your broker and your charting platform with the 2 links in the description down below for the broker to actually trade, and TradingView for your charting platform. Thank you so much for watching. For those of you who have watched me for a long time, you know that I took a break from trading. I was actually going to make different type of content, but I just couldn't stay away. I love trading so much, and I took almost 2 years off, and I'm back better than ever. So look forward to some great content hopefully coming in the future, and I'll see you guys in the next one. Peace.